Hey, everybody. Welcome to the Steps to Soul podcast. I'm your co-host, Brandon Bourgeois, Chris Sater. Today, we're going to talk about understanding business valuations, what really drives value. So first thing, Chris, I got to say, remember last week we gave you those Masters picks? I'm just going to toot my horn. Rory plus 650 was a lock. Although he tried to blow it on the final round, we cashed tickets. We cashed tickets, and I can't complain.
Yep.
So how do you find value? Obviously, I found value in Rory at plus 650. How do you find value in a business? What's funny is you can have two businesses with the same revenue, be in the same industry, and have two different values. And I think that's hard for people to understand because so many times you hear owners talk about, well, my buddy got this, or so-and-so got this multiple, or they told me they sold for this much. Well, there's a lot of things that go into that number and how you value a business. And not every business is the same. And that's not a bad thing. It's actually a good thing because if you're the better company, you want to get a better valuation. You don't want to be comp to your peers that aren't run as effectively as you, have as good structure as you, manage-wise, employee-wise, or customer diversification. So let's talk real quick before we dive in really. What and why does it matter to get a business valuation, or at least have a baseline understanding of what your business is worth? If you're going to go to market, we've talked about the multiple, we've talked about having your financials clean, all the prep work. But if you don't know where to put the value at, how do you know what to ask? Are you asking too little, too high? Are you setting yourself up for failure? All those different issues. And there's so many ways to value a business, asset approach, cash flow approach, their cost approach. Each one can vary differently for each industry, and finding the right balance and application is important. And then we talked about AI software, that's talked about the previous podcast, how it has flaws in doing valuations. I think today this podcast might give an even deeper insight into valuations. And if you listen to the previous podcast, these are two great ones to listen together and kind of pull the bits and pieces out of both to give you a better understanding, especially if you're a seller and a buyer and you don't know where to begin. We're going to really help you get started there. So first off, let's talk about the pre-listing phase if you're a seller in valuing a business. One, we set expectations on prices to attract the correct buyers. You also, by doing this, I think we've talked about is so important, getting your financials ready. It speeds up due diligence. If you've already got the last 3 years' tax returns, P&Ls, balance sheets, an asset list, you've done some deeper dives into the actual numbers. We talked about a Q of E previously for a seller. Having that information ready allows the broker to get a much closer target on the valuation, kind of like shooting archery. You want to hit the bullseye straight in the middle, right? But you don't want to kind of bounce around and set the price on an outside target. So getting those key metrics prepared is important. And why is that? You can be sold quicker. It's easier to find buyers. And when you're priced right, you find more attractive buyers. And buyers are more wanting to work with you. Nothing's worse than wanting to go look at a listing, Chris. And you can attest to this right now. When you see someone list a business so egregiously overpriced based on the valuation, it almost leaves a bad taste wanting to even start the conversation. Am I wrong?
No, absolutely. I mean, you hit the nail on the head with talking about it's almost like listing your house. You and I have both worked with so many buyers, and it's surprising how many of them wait until a buyer shows up, maybe calls them directly, to even think about the value of their business and evaluation. That's like listing your house without knowing what the market rates are, right? You're going out to a market and you don't even know where to start. A strong valuation isn't just about price. It's absolutely about preparation. It can change the entire outcome of the sale of the deal and everything.
You're absolutely correct. And I think the biggest part is we get a lot of owners today say, hey, these private equity firms, these family offices, these groups are all reaching out to me. And it's like, of course they all say they want to buy your company. They pay an X multiple. But if you don't know where your baseline is, how can you even respond to those emails if you think you have a good one? Or if you're talking to a broker, well, so-and-so brought me a price. And I'll give a great example today. And we'll kind of touch some points into it. We had a company here in town call us asking for a valuation. And they said, hey, a competitor has come to me, not in the region, but outside the region. I have a very specific niche, and they want to buy me. But I don't know where to begin. I'm carving out a very small amount of my revenue for a rental portion. It's very tiny, maybe not even 5 to 8% of the company. Something he wants to keep on the side that doesn't really apply to what they're doing. He's like, I just want to get the right price so I know I'm not getting taken, right? How many times have we heard that? Strategic comes in, and look, if you're a buyer, of course you want to get the best price, right? I mean, who wants to overpay, right, Chris? Who wants to get a good price? Everybody wants to get a discount if you can. Nothing wrong with that. However, as a seller, you want to maximize your walk away if this is your retirement or at least a large chunk of it. So we sat down with him and said, okay, we need these basic financials. We got to dive in a little bit. And it did take us a couple of days longer because we found a couple of things we had to clarify. We noticed there was a downward trend in revenue of 33% from previous years. His 4-year average SDE was around 296, which is still very strong. But unfortunately, we found a couple add backs we had to make adjustments for, and we've talked about that on previous podcasts. But overall, he had it 3 times, a specific niche with industrial. Can't say too much more. And he was like, that seems like a pretty fair price. I like it. You think it could be a little bit higher because of my niche? I said, yes, but remember, we have to look at a lot of factors. You are an owner operator. You're one of 3 people in the company. That's going to hurt your multiple, right, Chris? When you're owner operator.
Absolutely.
You had a 33% drop in revenue. Not good from the previous year. Previous 3 years, you were climbing to all-time highs. Still making great profit margins, just not the same volume. So we had to kind of adjust the multiple, adjust the valuation a little bit. Tell them, look, we think a range of X to Y, like 880 to 940 would be reasonable because you're also a niche business. And so he's like, you know what? I think that's good, but we'll see what the buyer says, right? And I got a call back. And you want to guess what he told me?
What's that?
They offered him $1 million. He gets to keep his full salary, get percentage of new businesses signed up, customers, gets percentage of that gross revenue.
Nice.
I was like, take the deal.
Yeah.
Company backed by private equity, a subsidiary, was like, they want you. You have the only customer outreach through most of the state of Louisiana into parts of Alabama, Texas, and North Arkansas. Take it.
Yeah,
that's a hell of a deal. And that's a company that sees value. Now, you may say, well, Brandon, you valued it less than $1 million. Yes, I did. I did that because he had a declining trend in revenue. This other company, they don't have his exact service, but he can be a roll-up and an add-on. So they know that, hey, for us to get this business, we're going to have to pay a little bit of a premium because this is the only guy that does it. And we want to keep him on board for transition.
Yeah.
So, yeah, they're paying a little bit at the higher end. But they know if they get him and they lock him in, their company's going to have market dominance in the region. So in his case, yes, it was a little over the valuation. But for an average person coming in to make debt service as a private individual buyer, going too much higher than that would have been tough, not having his knowledge. And most buyers aren't going to pay an owner to stick around and run the company for them, right? They don't have enough resources to do that. So there are times when a valuation is spot on, but maybe there is somebody out there willing to pay that magic check. He got lucky. Now, I'll say this, the deal's not done. So we'll find out what that LOI comes in, and we talked about this. Will that number change and get knocked back down during diligence, right?
Right. Yep.
Because he's also carving out part of his revenue. So we have to factor that in. So that's where I want to let you take a lead out here, Chris.
Yeah, hopefully in your case, you don't have a buyer who made a really great offer at first just to lock them down. We've talked about that before.
Yes.
Just to come back and start finding discounts, and you're 2 and 3 months into the process. So hopefully that's not the case in this one. But yeah, I recently had a client who thought their business was worth $5 million. And after running the valuation, it came out closer to 4.2. It was more on the low end of right there at 4. They were disappointed at first. They wanted the 5 million. That's where they needed to be. But they were grateful to have the information rather than putting it out on the market, letting it sit there stale and no buyers coming along. And why were they grateful? Because we worked over the next 6 months of kind of cleaning some things up, cleaning up the financials, putting some policies and procedures in place, a couple other things that we needed to do. 6 months later, I felt really comfortable that we could get the 5 million just based on he worked really hard for those 6 months to get that. It's not everybody can do that. We got it out to 5 million, got multiple offers right around that range. That's what he needed, and that's what we did. So the valuation gave them not just a roadmap; it gave them a roadmap. It wasn't just a number on a page. It said, "Hey, if you want this, this is what you've got to do to get to it." And so that was a great play.
And that's so important. We stress this in almost, I think, every podcast. It's better to talk to us 6 months to a year in advance and get things prepared. Some businesses are ready to rock and roll day one, right? They don't have a lot they need to do. But having that ready is so important. And we talked about the QOV last podcast, about how they're going to go back and do some real financial diligence. And the multiple is set off of that cash flow. So let's talk about the common valuation methods, because in most business sales, you're based on the multiple of your cash flow, right? Whether you use SDE, seller's discretionary earnings, as a metric, that's more for single operator or smaller businesses. EBITDA, earnings before interest, taxes, depreciation, amortization. Typically larger companies where the owner isn't the business or there's more key employees and staff in place. And then there's times where a business might be facing liquidation, or maybe we see this occasionally with older businesses that have declined is like machine shops. You have a ton of asset value, right? You've got real estate, you've got machines, but your cash flow might be 200, but your total asset value might be 2 million. And the cash flow analysis doesn't support the value. So you can't buy it based on the cash flow analysis. And there's also costs, like in real estate, where what would it take to rebuild the business, but that's mostly a liquidation consideration. That's not something you're going to see a lot when you're selling an active, ongoing, and I would say profitable business. So I'll let you dive in a little bit here. SDE has always been kind of the forefront of business brokerage for smaller deals. But what have you noticed lately with EBITDA changes and how EBITDA is becoming more and more of a relied upon metric, even for smaller deals, surprisingly, which I think is good and bad at times.
Yeah, you're right. But I think most Main Street businesses fall into that SDE method, right? And that's not a shortcut, it's intentional.
No.
Small businesses often they have owner's perks, personal expenses, one time costs buried in the books. You and I both see that all day, every day. Cleaning that up through ad backs allows us to show the true earning potential of that business. And that's exactly what buyers want to see. I don't think you get into EBITDA and DCF, discounted cash flows. Those are more advanced and used when businesses are larger, a little less owner dependent. And I always remind owners that I talk to, the more transferable your business is, the more likely we can use one of those stronger multiple based value methods. So just keep that in mind as you're looking at what method is going to be used to value your company.
And I think you made a great point there too. I see EBITDA into discounted cash flow being used more when you have someone like a strategic buyer buying a larger company where you're going to roll it up, where they're not worried about owner perks. Those little, like we talked, those metrics don't matter to them. The question is, how much can I use economies of scale, roll it up, like either keep it a subsidiary? That's what really matters to them, because that's how they can gauge where their performance really is, because they can't get down to the nitty gritty every day. It's almost like there's too much information coming in. Think about it. If you've got 3 employees, you know exactly how much hours per person that guy's going to generate for you in return and revenue. You have 70 employees, it's hard to kind of metrically measure every day. You can't keep an eye on it. So you use that EBITDA multiple to have a better, broad understanding of what your company is doing. That being said, it's still important to keep those financials clean, have them prepared timely, and be prepared. Because even if I use EBITDA, like any multiple, let's talk about any standard of measuring. If the numbers aren't reported properly on the paper and you use it to apply a multiple, you're exacerbating the problem and setting the wrong metric value. And I think that's so hard for people to understand. And we talked about common valuation methods a second ago. Let's talk about comps. And I mentioned it earlier in the intro. Oh, so-and-so sold for X, right? So-and-so sold for Y. Let's be honest. Every business is different. And we can all find comps, right? Whether it's deal stats, biz buy sell, other places that we have access to. And they're all broker entered. So let's make that clear to everybody out there. Almost 99% of comps out there are broker entered. You don't have all the information. We don't know about every single strategic and key employee that went into the multiple. Often we get revenue, EBITDA, SDE, if real estate was involved, if there was a seller note, SBA finance, the core information. And the customer I spoke about a little while back on the valuation, like, well, I saw online that companies like me got five times multiple on these comps. I said, well, what was the revenue? Well, I didn't see the revenue. Okay, well, where was it located? Well, I didn't get that. When did it sell? I don't know. You can't apply comps and just generic assumptions to a deal. You have to look at all the factors. He's an owner-operator. He had a decrease in revenue. Even if industry standards multiples are 5, that's for larger companies. We see multiple ranges change by the size and the amount of revenue you're doing. Ranges million to 1 to 5 million in revenue, etc. Just doing a Google search doesn't give you an accurate representation in how to apply it. So with that, what really drives the business value and how we determine it? I mentioned revenue being consistent. In this case, that guy's revenue had dropped. I'll let you highlight it because you sold a deal with massive customer concentration issues. Why don't you talk a little about how that revenue and customer concentration can be a hindering factor, even with strong cash flow? Say you're making $1 million EBITDA, but your concentration of customers is so high. How do you work through that?
Yeah, that's going to come into the risk, right? Buyers are always looking at the risk, and that's where the discounts of things come into play. If you had 2 companies both doing $1 million in EBITDA, but one had the recurring revenue that you talked about, had documented processes, had a manager in place, didn't have that customer concentration, maybe we can put a 3.5 multiple on it. The other one comes in, it's got all those customer concentration, it's got 88% belong to 3 customers, something like that. Maybe it gets a 2x, something so low because there's so much risk. That's a $1.5 million difference there on just EBITDA alone. So you got the same EBITDA, but drastically different values, different multiples. So yeah, you've got to
Mm-hmm.
factor all that in, because that's what buyers do. They're going to look at those things and say, "Hey, this has a lot of risk to it. What do we need to do to kind of compensate for that?"
That's exactly correct. And a lot of times when I see comps out there, when we're doing evaluation, I see, well, this one sold for a very low price for them for the SDE. Why was the multiple so low? Well, could be owner got sick and had to sell right away. Could have had a customer concentration issue. It could have lost a key customer going into the deal, and that affected the revenue and SDE the cash flow going forward. So someone said, "Look, I'll pay you for it, but I got a discount." What just happened? Because you've now lost like 20% of your business, right? So you have to kind of, I'm not making up stories. Let's make that clear. I have to assume a little bit. If you see a company sell for well below its market value in the multiple range, there's a reason why. And those are comps you have to throw out. Same for the ones that sell for way too much. Very often I've heard, well, he got 10 times. Okay, well, was real estate involved? Well, yeah. Well, we got to take that real estate value out of the price, right?
Right.
Was there a certain package? Was there seller financing? What was the total consideration, as we always say? Because that's the real driving factor. Because when I hear 10 multiple, I go, they probably had some other things built in they didn't tell you, or he's fluffing. Come on.
Right.
I mean,
Yeah.
not every owner's going to tell you the truth.
Yeah, might be a lot of seller financing on the back end, earnouts. The complete package might be a 10x after the real estate and everything else. But and a lot of sellers overlook proprietary assets in the value of their
Mm-hmm.
business, whether it's custom software, vendor relationships, SEO rankings. If you're ranked number one every time somebody
That
searches
matters.
on Google for your business, that's a huge value driver, right? So you got to factor all those things, and that's not something you and I always get to see on comps.
That's right. And I think people also forget location. Look at companies in Alaska getting crazy multiples because they're the only one up there, right? Unlike here in Louisiana, the same company might get a much higher multiple in Alaska because there's only 10 HVAC companies in Juneau, Alaska, right?
Right.
Versus 100 in South Louisiana. Those issues matter. And you have to kind of and that's where brokers have to be subjective and use good common sense. And I think people forget that sometimes. That being said, it doesn't excuse a broker for putting a 10x. I mean, what was the business we saw the other day, Chris? That was a promotional products business. Tell that crazy asking price for the cash flow.
Yeah, I think it's got EBITDA or a SDE of 750, and they're asking $7.5 million on Biz Buy Sell. It's like
That's
maybe
just that's unrealistic.
yeah,
It's all blue sky.
you and I don't know all the intricate details. We didn't sign a non-disclosure agreement and ask about it, but it's to start there without a description in the online of why they're asking so much. They've shrunk their buyer pool if they've even got a buyer pool at this point, and I think brokers need to kind of detail why they're asking so much in their listing if they're going to do it online, even if it's confidential. Of hey, this has proprietary software, it's ready to be scaled worldwide,
Mm-hmm.
something. But if you're just going to list it like it's every other business out there with a 10x multiple, I don't know if you're going to get too many inquiries on that one.
And that leads me right to my next topic: common misconceptions about valuations. I mean, you said it right there, the key word: potential. Potential is great, but people buy on historical trends of revenue and forecast forward based on that. If you're an upward trend, yes, you have potential. You're going to get a stronger price. Obviously, if the trend is down, like the valuation I spoke about earlier, I had to kind of cap it because you lost 33% of your revenue. That's a lot of revenue. Let's be honest. That would scare most people off, or at least put up a red flag, as we say. So potential, if you're a seller out there, potential is great. If you haven't done it, you're not going to get paid a lot for it. Just put that in the books right now. Write it down. Remember that. I don't want to hear potential to do so much work. If you're not doing it, there's a reason why. And now, let's be honest. The few times I make an exception is it a capital expenditure issue and you're 66 years old and you don't want to spend $300,000 on a new fleet of vehicles? That's a little bit different, but you still haven't done it. So don't expect to get paid on a multiple because of that. It's not worth if I want to retire. It's not worth whatever I need to retire. That doesn't matter to a buyer. When a buyer says, I got to pay you what the business is worth. If your retirement, you need $2 million and your business is worth $1 million, guess what? You got a problem. Or you need to change your expectations. How often do we hear that? Well, it's not my retirement number. Well, It's not going to be your retirement number unless you dramatically change the structure of your company. Yes, anyone can give you a valuation with a number on. Let's be clear. There are brokers out there in groups that'll put whatever number you want on a piece of paper. We've seen it, right, Chris?
Oh yeah, for sure.
All the time. I saw a golf cart company we're talking to got a $4 million valuation. At one point, EBITDA was 1.5 and 1.3. Yeah, you might be able to get that. Previous years behind that, 500, 600. They had a bump and they didn't account for it. That's a worthless valuation because the numbers had already dropped by $1 million in EBITDA. You can't tell me that a multiple holds at that rate. And the comps they quoted were garbage. I went and found the same comps on the same site, didn't apply at all. Just doing basic research, as a broker, I could tell that was wrong. My inventory and equipment add value. And I think that goes back to the asset approach, and I'll let you touch on this a little bit too in a second. I feel bad when owners say, well, I have all this asset value in my machinery. It's like, yes, but your cash flow doesn't support purchasing it all at once, which is the problem. Or that machine was worth $30,000 a few years ago, now it's worth 10. Well, it's that's a $20,000 you have to go buy in the market. Is it really? I can't give you value for something that doesn't generate value. Does that sound fair?
Oh yeah, absolutely. I tell clients all the time, you're worth one of two ways. You're either worth the multiple of cash flow because we've got the buyer has to service the debt, and that's the approach, the SDE approach, multiple. Or if your assets are worth way much more than that, then you're worth that. And that really requires almost getting into an equipment appraisal and making sure that what you think of the value of those assets is actual. I had one recently. He's got $40,000 of cash flow, not much, right? But he's got $700,000 of assets. Are we going to find a buyer? Maybe, but it's going to be somebody who doesn't really care about his cash flow. It's going to be somebody who wants the customers, who wants the operation he has set up. Because let's face it, getting a business with 20, 30 employees, that's no easy feat. So
no, it's
he's
not.
doing something.
And there is value there.
Yeah, he's doing something. Wouldn't say wrong, but something's going on to where your cash flow is so limited. Something needs to change in the business, I would think, and very soon. But if you got $600,000, $700,000 of assets, we can't even use the multiple of cash flow. We got to go with the asset value, and we're just working with a much smaller buyer pool to find.
No, you're correct. And a lot of times, businesses like that appeal to a very small buyer pool. Someone with cash that can sit on it and turn it around, and they want to get it for, quote, a discount, right? Like, hey, I can buy it cheap and I can turn it into something and sell it. Or really a strategic who's got the infrastructure marketing in place, economies of scale to cut some costs, merge it in. A great example we had is a banker in town had bought a business from a customer he knew, paid $200,000 for it roughly. This thing was making $1,000 a week in revenue after he took over, just getting crushed. And it had screen printing and, putting labels on t-shirts and all that. He's like, I just want to get my money back. We're like, you're not getting your money back. You've got $70,000 in equipment. You got 3 good employees. Well, I say good. They were trained. Apparently they weren't doing something right.
Right.
He's absentee. Business is faltering. I mean, it is hemorrhaging. This is one that you've maybe got 3 months for. You just say, I'm shutting the doors, right? It's not worth it.
Right.
And I've had people say, you don't take a listing like that. Well, we thought maybe we can help. There's someone who's going to need that equipment, and there's somebody that sees value there. We found a company doing $20+ million in revenue in the area that said, you know what? I'd like to get into that space. I'd like to get that equipment and those employees trained. So I don't have to go, like you said, find 4 guys off the street, put them in, train them. He's got a customer list. He's got some inventory. I'll give him $75,000 for it. That helps me get started day one making profit instead of having to go out there, source brand new equipment, source employees, fight the headaches. I've got a customer list right now. I can wrap it up to my other services. That's where it made sense. And the value there was not on cash flow. It was strictly on asset value. Yes, and the buyer, the first buyer lost his investment, but the second buyer picked up something at a discount, but it made sense for their organization. So that's where the asset metric evaluation plays in so important. And I think people overlook that sometimes for struggling businesses. Just because we can't do a cash flow analysis doesn't mean we can't find value there. But like we said, potential, you don't get paid on it, especially ones with negative cash flow.
That's absolutely for sure.
And I think another topic on valuations, we talked about how you use your cash flow to value it. We talked about the asset approach. We talked about the key factors on the front end for diligence of a seller to get things organized that help get a proper valuation. Let's talk about market factors. Now more than ever, look at tariffs, look at all the things going on in the U.S. economy, the world economy, times like COVID a couple of years ago. it's very hard to put a number in effective valuation on market times. The biggest and probably the most common complaint I see that I think is fair is interest rates. And I think sellers sometimes forget that. Interest rates dictate a lot what a buyer's purchasing power can be, right? SBA has opened up a larger buyer pool for most people with 10% or less down, seller equity injections, a lot of creative financing, partial rollovers of ownership. But those rates matter. And even though your business may be valued at, let's say, $1 million for easy math, at 10%, 10.5% interest rates right now, the problem is, can the cash flow support the debt service to buy it, right? I mean, we see that. And talk a little bit about the issues you've seen with customers lately when they talk about, well, is it a good time to sell or not? There's never a perfect time, but I'll let you kind of dive in about how that interest rate, timing, and market availability all play a factor in how you value a company.
Yeah, absolutely. Because while we're putting the multiple of cash flow that we get, we see it from comps. And granted, we've stated we don't have all the information on those comps. It's a starting point. But one of my biggest checks on valuing a company is checking those interest rates, running the debt service, and we want to have a very broad buyer pool, right? We want to attract the most amount of buyers possible. So we want a company, we want to list the company with a asking price that somebody can come in 10, 20% down and they can service a debt and they can make themselves some money.
That's
And
right.
how much money that is really depends on what our asking price is compared to the interest rate. But we don't want to list the business where they put 10 to 20% down and everything else that they make goes to debt service where there's no money
Yep.
left. First of all, I don't think you'll find a SBA bank that would do that deal because they know that that buyer needs to have be able to pay his bills, needs to be able to pay his house note, his car note, whatever he was making before he's thinking
Standards
about
of
buying
living.
business. Yeah, exactly. So interest rates play a part in that. And so when we're back in 4 and 5% interest rates, we can ask a little bit more for businesses because that there's that much room in the spread of what we're asking in the debt service. But yeah, you nailed it when you said 10%, 10 and a half. Whew, that shrinks asking prices a little bit, not a ton, but you got to get in there to where you can leave a buyer leave a little meat on the bone for them to walk away with.
Correct. And people forget too, rates can go up with SBA. You could buy a business at an 8% interest rate and it can go up. And we saw defaults at the highs it been in a short term. And a lot of that was rising costs and goods, some other issues of the economy. But if you get a 2% increase in your interest rate on your house, you'd freak, right? You'd be furious. Imagine with a business.
Yeah.
I think people just don't always put that in perspective. And it's so important to keep that in mind as a seller. Now, that being said, when rates are high, yes, it can scare buyers and it can scare price a little. But if you're also the only person on the market, you could dictate your price a little bit harder. And I think people, you have to kind of find that sweet spot and be willing to be open-minded to it. Maybe you do more seller financing, some creative deal structure. It's all about the total consideration. I tell people, just because we give you a range or a number on evaluation, that's not always your walk away. And I think people don't understand the value of the transaction, as my dad always taught me. And that can vary. Let's even talk about this a little bit because I think we didn't cover this enough, and I definitely don't want to forget this. Value different from a stock sale versus an asset sale for evaluation. There's a whole bunch of factors that go into that, right? I mean, asset sales typically you keep the cash, receivables, you pay off your payables. But what about cash-free, debt-free stock sales, right? We've seen that with you, multiple deals where that walkaway number can vary a lot based on working capital being left behind, working capital pegs. I mean, seasonality of businesses. So just because a number's on paper doesn't mean that's going to be sometimes even really that close to what the final deal structure might look like at the closing table.
Right.
When you talk about interest from seller finance, leaving working capital behind, deal structure, asset versus stock sale, tax implications on either one, they change. There's a lot that goes into that. Elaborate a little bit on cash-free, debt-free, because if you've never heard that before, I think that's important to understand if you have a bigger company, what that means and how it can affect the value of your business when you actually sell.
Yeah, and so lately I've seen that in offerings, and they weren't even stock sales. They still wanted to buy the assets, but they still had this deal structure in place where they were going to let the owner keep his cash, pay off all long-term liabilities. But they wanted to take over working capital so that the business had operating cash on day one. So that what that meant is accounts receivable and accounts payable and current liabilities, right? And a couple other things in there, prepays and things of that nature for current assets. But yeah, I've seen that even in asset sale LOIs where they're expecting that now. And this is coming from the private
Mm-hmm.
equity world. So obviously, this has entered into their playbook of, hey, get this on the table. So you've got to kind of factor that into an asking price when you're going to market of how much is your working capital worth. And if we get an offer for what we're asking,
Mm-hmm.
are they expecting working capital or not? Because that's a huge. Sometimes a couple deals I've worked on, it's been a $1 million addition to the deal. We've been able to negotiate how my client gets compensated for that. We didn't just give them the working capital, but yeah,
Mm-hmm.
you've got to factor all those different angles into the playbook.
It can get sticky because there's a lot of ways to cut that cheese, and it's tough. And that brings a great point. I didn't even forgot to mention this with the valuation we did. The company they're doing an asset sale because he has no debt. He's keeping about $500,000 in cash and savings for the company. So he's like, my walkaway is 1.5. When I ran a number, I said, take the deal.
Yeah,
So yes, they're offering me, but your walkaway is 1.5. And I think people say, well, that's already my money anyway. Why should that count towards the deal value? It matters because if in a year from now you lose half your equipment in a natural disaster or it breaks on you and you spend that money, you're giving the buyer brand new equipment, and you really can't metrically add that much value to the deal because that's equipment you need to have in the deal to continue running cash flow, right? I see people now. Look, let's be honest. If you're adding a brand new, say, massive truck the week before the sale, I understand wanting to negotiate that. But if it's part of ongoing business and you had a fleet of trucks going bad and you replace them 5 months before the sale, you can't hold the deal hostage on that. You want to watch buyers walk away and affect the valuation. That will happen the minute you do that. Because they say, hey, man, look, we're buying your business. You would make those changes regardless if we bought it to keep the business running, to generate the same revenue. You can't hold me hostage on it. And I think people forget too, and I'll lead off on this final point. I told the seller of that business we did the valuation for. One thing about that company, them doing an asset sale, which is going to greatly help them, is you're going to get to redepreciate all that massive equipment. That's going to really help their bottom line. So if economies of scale merging you into their operation, redepreciating the equipment, that deal looks a lot different for them on the back end than the front end. And I think people always forget there's always two sides to every deal. How you start the deal, what it means to the seller, and what the long-term implications for the buyer mean, both tax, income return, market presence. There's no way to always put a metric number on that, but you have to keep that in mind as a broker too when you're working with the seller, when the right buyer comes into play. Because how many times we hear the buyer say, oh, well, it's going to cost me all this money. It's like, yeah, but you're going to get to redepreciate $500,000 in equipment. So what's your real bottom line going to be, right?
right.
We see that all the time. So if we leave you with anything today, if you don't know where you are, you don't know what you want to be with your business, we always say this: start early and talk to a broker like us. Get a valuation, get a base understanding of what your business is. If you feel like getting the QV like we talked about in the previous podcast, that's great. That is an A++ move. You don't have to do that. But understanding keeping your books clean, getting things organized so when the broker comes in, he can do an analysis. It also, to be fair, it's going to save us having to ask you 500 questions that you're going to get tired of. Like, well, why are you asking about this expense? What about this revenue? Why is it different this year? Because we're going to look at that, because the more factors we can identify pre-listing and pre-going to market, the better chance that multiple's correct, the valuation is as close as it can be, and you can more likely sell for the best possible price.
Yeah. Yeah, I would
Yeah.
say the businesses that I've sold that went quickly and at a premium price, it wasn't because they got lucky. The
Mm-hmm.
owners had created a business plan for their exit. They understood their value was built over time. They started with an exit plan, and we didn't just get there at closing. And it didn't take 2 or 3 years to sell their business. We went in
Mm-hmm.
with a plan, had nice documented financials. Everything was squeaky clean. It
Mm-hmm.
was transferable, right? That's a key
Yep.
word. Is
That's a
this
great way to
business
say it.
transferable? If the owner's sitting there working 60 hours, that's not an asset. You want your
That's a
business to be handed
liability.
over. Yeah, you want to hand it over with standard operating procedures in place. Everything's been documented. Here you go, Mr. Buyer. This you can continue making the same revenue, same cash flow. You can
Mm-hmm.
grow it, and this is yours now.
You're absolutely correct. I think that's so underappreciated advice right there. As hard as for owners sometimes to see it in that light, it truly is. And if you leave anything today, take Chris's final point to heart, because it will. If you practice what he just preached, you will have a much more favorable outcome when that time comes. No matter what it is, whether it's strategic buyer, you go to market, you want to hand it off to even like a son or a family member, or do an ESOP to your employees, that's going to affect your value. And that's going to drive what your final return to your bottom line is in your pocket when you want to exit. And on that note, it's been a great episode, Chris. For everybody out there, you can follow us on YouTube. You can check us out, like, subscribe, comment. We'd love to hear from you. We'd love for you to give us any topics you want to hear us talk about. And we got a special guest coming up in a couple of weeks that I think you're really going to want to hear from and give you some great insights if you're a buyer and it's a seller, what good buyers should be doing. You're going to want to check us out. Until then, Chris, it's good seeing you.
Yep.
Steps or Soul Podcast. We will see y'all later. Have a good one.
Talk to you soon. Bye-bye.
You too.